Welcome to the 19th episode of the Crossroads, a weekly financial show for our generation. And for the listeners, welcome back to the Long Game Podcast. This week, we are diving a little deeper into our crypto series and talking with Jaimin Desai, the founder of Reconcile Money, or also known as the Crypto Tax Guide Guy on Twitter. And he's building one of the most helpful financial tools I've ever seen, which is helping investors pay less in taxes. So I'm super excited for this conversation. And Jaimin, we really appreciate you taking the time to come on. But before we dive in, if you wouldn't mind giving the listeners just a little context on your background, like how you were helping friends and family with money before, and just kind of what led you to starting Reconcile.
Yeah, so my background, come from a finance and accounting background from Boston College. And, I previously worked at a hedge fund back in high school as well, so a small internship, kind of where I started to dabble into investing and realizing the power of compound returns, especially over a long period of time, and realizing that's kind of how the wealthy, get rich and stay rich. Well, actually, the stay rich part is the tax part of things, which I'll get to in a sec, but to get rich, you kind of really have to be invested in these markets, right? And so for the past 10 years, I've been managing my money and then slowly taking on my families, my brothers, my parents, and some friends as kind of like, kind of their investment planner to some degree. And so like for me, understanding how a return is calculated, it's not just the number you see on the Robinhood at the end of the year, but it's really like the after-tax impact of like how much can you take home as your real return. And so when I've thought about just investing, tax is obviously the number one expense factor in that. And so for me, it was always like, okay, how do I optimize my taxes to make sure I'm not paying out so much cash at the end of the year? And so with the past 2 years of trading and this retail mania across crypto and securities markets, especially, I saw just at least a lot of my friends making a lot of money in this stuff, and they treated it like gambling, so they're so excited when they're winning, and they didn't really realize the different tax implications of like what a wash sale was, or like the fact that when you made an $80,000 gain maybe from meme stock trading, like, well, you have quarterly tax payments you have to think about. You have to think about, like I said, a wash sale before as well, and the fact that like, well, how are you, especially if you live in a state like New York City, how are you going to pay 50% tax on that? Like, do you have 45K in the bank just to give out to taxes? So diving deeper into it, I really realized there's a humongous gap in the space because there's so many folks trading now, but there's very few professionals who can give them the tax help. And that's really where like you're seeing the kind of bad actors, I'll call them, creep up in Discords and Twitter and Reddit, who are just giving garbage tax information. And it's almost promoting more like tax fraud and tax evasion than it is sound tax, planning and guidance. So that's kind of where we want to step in. And, part of my mission is to help, democratize access of these smart tax professionals, investment advisors, to newer young investors who can really use this help.
For sure. And so I guess kind of like when the idea for Reconcile started, did it just kind of come from you seeing that little trend with your friends and stuff, and then it was like, there's got to be more people that need this, and then it's kind of just grown from that like original like incubator idea?
Yeah, exactly. I mean, it was something where I faced this problem myself of always thinking like, how much tax do I owe? And I, in my head, would always run the mental math of like, I made this much gain. Okay, let's ballpark this percentage against that, again, as my taxable liability. But then as you keep trading more and more, you really kind of lose track of it by the end of the year, right? And so you kind of have a very wide, inaccurate range. And not to mention, that's just the liability side. There's other like new cool techniques you can do to really offset that or tax defer that as well. So, when I essentially became the pseudo tax guy of my friends' group chats, that was like, okay, well, if I can do this for them, I could probably do this for, the millions of traders out there as well. And, when looking at the space, there was really no one else doing these types of things. So I just felt like it was the perfect opportunity, and the timing was never better to do this.
I think this is super important because this last, few weeks, I've been going through a lot of clients' investment portfolios and, annual reviews and saying, hey, great, like, this year we really need to build savings and do this, but you have a taxable investment account that has some things at losses that I can sell, move that, fund your Roth for this year. And, you know, some tax loss harvesting, some just, you know, use and move money from taxable accounts to Roth accounts, figure out where's the best place to sell that from that are inexpensive, bad funds from before. But, you know, I'm doing this not at scale. Like this is a one-on-one person thing. And there isn't a whole lot of efficiency in doing that. And so, you know, for a firm like us that isn't high AUM, you know, investment management is the main focus, like ours is really on planning, it's really hard at scale to do this for all of your clients, which is a huge value add. And I was looking at your guys' website, and to me, like the tech is super exciting. And, you know, I like saw this and I saw your Twitter, but I didn't know too much about it. And I didn't know there's an advisor dashboard. So we're not going to spend all of today talking about that, but I will say that when this is over, we're going to spend more time figuring out like what role that can play inside of our firm, because to me, I think that's a huge value add.
Yeah, I didn't know it was possible to be excited about a tax software. Like I love it.
I mean, if we have that between that and Helios,
Or Holistiplan.
Holistiplan for like analyzing different scenarios that are not just investment related or like, you know, account related and all that stuff. But not why we're here today. So today, let's really try to get into, I've written a bunch about this, and this is where I feel like my knowledge base is kind of the best, but I really want to talk through with you because obviously not everybody sees all of our content. So we want to put in different places. We want to first go through like, you know, how is crypto taxed? And I know it's kind of similar to stocks and everything else, but not everybody even knows that. So let's go through and we're going to start there, and then we'll get to like, you know, tax planning mistakes that we see and maybe some different tech platforms or things that we can use to make their lives better. So start very simple. Let's just go through, you know, if I'm buying Bitcoin, Ethereum, just regular cryptocurrencies, how are they taxed? And let's break it up between short-term, long-term, and start there.
Yeah, sure. So, you know, people, the number one thing I see with how Bitcoin or how cryptocurrency is taxed is just because people assume it's a different decentralized world, like it doesn't count as income and you can hide it against the IRS. And so that, you know, number one off the bat is just wrong. And I want to make sure that like myth is no longer spoken of anymore. Secondly, I mean, it's taxed in the very similar way securities are. If I'm not mistaken, I believe the SEC has called it a security, but the IRS hasn't. So it's one of those things where like the trading commission calls it one thing, the tax authority calls it another. You know, the IRS flags it as property, although it doesn't give it, you know, 1031 like exemption either. So it's kind of weird in that way. But you know, I'd say that the key things to know when it comes to crypto tax is if you're buying and selling it, you know, that's a definite taxable transaction. So you will either pay taxes on the gains you made or offset some gains from the losses you've got there.
So right in the beginning though, just buying is not a taxable event. Like some people get even that part mixed up, is like you're just basically using dollars to buy Bitcoin, not a taxable event until
Correct.
you get to the point that you sell. There is where the taxable event occurs, and how you are taxed is based on time frame. So it's whether the time you bought Bitcoin to the time you sold it is less than 12 months or more than 12 months, right?
Correct. So, you know, if you're going from fiat to a crypto, there's no taxable moment there. When you're going back from fiat crypto to fiat, there's a taxable moment there. When you're going from crypto to crypto, like let's say you're converting Ethereum to Bitcoin, that in and of itself is also a taxable transaction.
So they view, so just to hit that, so they view when you go from Bitcoin to Ethereum, that you basically went from cash fiat to Bitcoin, Bitcoin to cash, cash to Ethereum. So the selling is where that taxable event occurs, and where I think this is something that, you know, I know this podcast is meant to be for new people who are like maybe not fully into crypto yet, so they maybe haven't thought about it. But people who are in crypto that are making those, I don't think they realize the distinction that happens there.
Right. So when you're swapping, you know, it's a taxable transaction there. You know, it's kind of like if you owned a home, you sold it, and then you bought a new home for investment. You know, it's kind of like you're paying the difference in the gain there, which is, you know, a pro tip for other folks listening to this. I always recommend my friends when they're buying an NFT, especially because buying an NFT triggers a similar taxable transaction. what you might want to do is like, instead of using previously held ETH that has maybe appreciated significantly to use to buy the NFT. Let's just say, for example, let's just say this NFT is worth 1 ETH, like go ahead and buy 1 ETH in Coinbase right now, transfer that money into MetaMask and then buy it immediately. So that way you're not using the old ETH and, and having to realize those gains, right? So now you can just kind of use like a HIFO or kind of like a last in first out accounting method. And
I was
then
just asking about that. So you, in that situation you just described, you're obviously using HIFO or LIFO or whatever is your accounting method, but you have to stick with that, right? Like I can't use HIFO to use for my Ethereum to buy my NFT, but then want to harvest some gains later and use first in, first out and switch my accounting method, right? Because if you do that, you have to go back and amend previous returns and stick with your future accounting method.
Exactly. No, that's right. And that's really where you need a tax planner or some sort of person with intelligence in that front to kind of, simulate what that implications would be for prior returns and also future returns.
Okay, it looks like Trayton is frozen, so hopefully that doesn't like mess up the recording in any way. But anyways, okay, so that makes sense. I think that's like step one, and for people to understand like where does the taxable event even occur. But it is super important. This time frame thing that I keep bringing up is super, super, super important because talk about how if you sell within the first 12 months of holding that investment, what does that actually do?
Yeah, so if it's an investment, then it'll fall under the kind of capital gains tax structure. And so if you're holding it for a year or less, so 365 days or less, it gets taxed at your typical ordinary income is what they call it, tax rates. And so that's the same as the high tax rates you're used to with your W-2 wages. So if your job deducts 40% of your taxes, expect that much to get deducted from that short-term capital gain.
Yeah, and that distinction is what's really important as well, because obviously we're not going to just like assume that crypto traders have higher income than the average person. But I do think it is important because if you're somebody that's a high income earner or you're generating a lot of profit from trading and whatnot, you might be sitting at a 37% capital gains rate. So it is something so even now, if we talk about, the person that goes fiat to ETH to buying an NFT, well, when you sell or use that ETH to buy that NFT, you might not say, wow, I just had a $50,000 gain here that I'm not holding for taxes because I converted it or ended up buying an NFT. And then now you come back next year, come tax time, and you're like, oh my gosh, I owe so much money, because you see people do it where they go from one to the other, to the other, to the other. And even if their portfolio doesn't overall grow, they could be still in a point where they only have on paper large gains, but they don't even have a portfolio that has grown that much.
Right. Oh my God, we could spend so much time on this. But yeah, I mean, it really comes down to keeping track of these things and being smartly aware of how you're using the crypto, because you can, I mean, think of this scenario too. Someone got paid out, let's say, a big amount of money as ordinary income for being like a creator or helper of these NFT projects, right? So they got, let's just say, $1 million in Ethereum back when it was like, let's just say $4,000 a coin, right? So what is that, like 225 ETH? So I got that math right?
Yeah.
Right. 25, yeah, whatever the number is. Let's say they got paid out there, and that's ordinary income, and they live in a state like New York City, right? So the highest tax rate in New York City with, the federal and state and local tax, like about 50-something%, which is huge. So essentially half that is going to come back to the local, the tax departments. So you have pretty much $500,000 in taxes. Now, Ethereum has, let's say, it's fallen down 50% since then, so it's like $2,000 a coin now. So that same value of asset is gone down from $1 million to $500,000. So now let's say if you want to take that loss, you've got a $500,000 capital gain loss, but you made $1 million in ordinary income. So like that's one kind of thing that's interesting about this space that, I'd love more discussion to be around, is the fact that like from a capital gain loss, you can only deduct $3,000 against ordinary income every year. So like some people might be like, well, I owe 500,000 in taxes, but I lost 500,000 on the value of the investment. It's offsets, right? And like, not so sure about that, right? So like, unless the IRS comes out with guidance right now that like clarifies this, I mean, right now we're just going based off like what we presume to be the right way to tax things based on other tax law. But you're kind of screwed in that scenario, right? If you're kind of accepting payment in crypto, getting a bigger tax bill and then realizing you can't really offset that with the capital gains loss.
Yeah, I think that's a huge point. I think one thing that also to hit on too is like some of these people that are accepting crypto as payment, like if you get paid that $1 million, first understand like what you owe of taxes on your payment. So that is earned income. You're obviously the highest tax bracket. If that money is straight into ETH, you never had that, okay, I set aside this amount of money for taxes. And so then you might say, well, great. Like let's say this payment happened, middle of June of last year where crypto was worth a significant amount of money. And now you're at the point where, okay, I owe in taxes, I forgot to withhold from there. Now I have to sell ETH at 2,500 when I bought it at 4,800 to generate the taxes or the money to be able to pay for those taxes. So you're just kind of getting yourself in a really tough situation when the currency or the crypto is volatile and kind of going all over the place and not super stable. But
yeah, that's exactly right.
Okay, so short-term capital gains tax at your ordinary income rate. What about long-term capital gains?
Taxed at much lower rates. Goes from 0 to 20%. Although they, NFTs may get taxed at 28% as the highest rate, just because that's some say that's a collectible item. Although it might get classified as just like a digital art asset, and that might get down to just 20%. But you want to optimize for long-term holdings because of the substantial tax burden you might save yourself, right? At least maybe 20% in some scenarios.
Yeah, I think this is the hard part because that example of the person with $1 million, like they're going to be in 37% ordinary income rate and they're going to be at 20% long-term capital gains rate. So you sit there and say, okay, 17% tax, like that's a really big difference. But then there's the other side of it of like, well, do you really hold on for the tax implication? Like, I think for certain things, like, it's something that you want to take into account. But if you look at like the Peloton, employees that had all of their stock options over the last year where they were going to hold on past, a year past when they were able to exercise, they're sitting at a point where, wow, I should have just paid the extra 17% tax versus the 80% swing in the stock itself. So I think, taxes are something to be aware of because we need to make sure that we have the right amount of money available and we can plan for it. But it's also the side of like, it can be really dangerous to make tax your trigger for when you sell different cryptocurrencies. But again, for us, like, I think, the one thing I want to reinforce here too is we aren't preaching cryptocurrency trading. We're again preaching, if you want to be in cryptocurrency, to invest in cryptocurrency in the projects that you are going to believe in long term, where you aren't really like, oh my gosh, Ethereum just went down 40%. Now I want out because I don't believe in the use case of the project. Like, we want to be investing based on use case where whatever happens over a short time frame doesn't change the belief that we have of what it'll be in the future.
Yeah, I think that's a good way of thinking about it. Plus, from what I've seen too, if you're someone accepting payment in crypto, you're probably a hodler. So for you, like, the price fluctuation is something you're probably used to. And so it might not be as big of a concern for them. I think what scares me though is the fact that there's no withholding taken out, at the moment. And so that, coming back to your point earlier, like if I got paid, let's say $1 million in crypto, I would have loved for that kind of withholding to be taken out immediately. So I no longer really have to think of the burden. Whereas now, you have to, like I said, like you've got that big burden, the value's fallen substantially. You're kind of screwed. Like, do you sell the ETH at a big discount now to pay back the gain? But now you're also incurring that loss, which so it's just kind of like a lose-lose. It almost feels like to me.
Yeah, this is the business owner dilemma. Like, it's the same thing for us. Our money comes into our business, and it's like, if you don't plan for taxes, then you're going to be in trouble. It's, all business owners do this the first year. They commingle their finances. They don't save for taxes. They don't understand the self-employment tax. So these people who are self-employed that are being paid in crypto also have this 15.3% self-employment tax they probably didn't even factor in on top of their federal income tax bracket. So, all of these things are like, this is where I feel like tax planning and who we work with is the biggest value add that we can have, is because you can just save somebody so much money by understanding just the tax impact of what they're doing and how different decisions can trigger completely different tax impacts on what you have to deal with.
Yeah, I mean, it's funny because so many of these crypto investors are like alpha seekers, and the best alpha there probably is just good tax planning.
Mhm.
Yeah.
And do you ever plan on like integrating with either brokerages or like crypto exchanges to kind of like make that tax planning easier? Like there's one software I use that's called Catch, and it's like for self-employed people, and it like syncs to your bank account, then holds whatever percent you want for taxes, like in a savings account on the Catch platform. Like, is that on the reconcile roadmap or anything kind of close to that?
Yeah, absolutely. If we can foster close relationships with these companies, that'd be amazing, right? Like if we were working with Robinhood, for example, and at the time of purchase or sale, it kind of flashed a tax implication alert for you, which we could maybe power. How amazing would that be? If you could be like, you're selling these shares, great. Okay, here's, what you're gonna take back from us. Here's probably what your taxes will look like. So here's kind of the net you will have after this. Do you want to still do this transaction? Or, hey, be careful, this might be a wash sale. Like, do you still want to do this? That means this, and that, right? So I would love that. I mean, I think that's a big problem we have right now, is at the point of these transactions, there's really no tax guidance. It's all kind of this like free, like wild west arena where every trading platform is really only incentivized to make their users trade more, not less, and not really think about the tax. And they don't even do a good job with tax reporting. So it's really just this kind of, shitty situation for investors where they want to make money, but then where do they turn to for taxes? And then they come, crawling into my DMs now asking for tax help. And one of those things too, where like the point of our software is to help you throughout the year. And so if you're someone looking for tax help after the year ends, well, you can't really even do anything as a planner or an accountant because it's already, the time period's passed. Or if you kind of come to someone at the end of every quarter or at the end of the year, well, like you kind of missed out on all the help you could have given in between those time periods, right? So
I think, sorry, I was gonna say, you made a point about wash sale rule in there. And I think sometimes we take for granted that people even know what that is, because earlier on we were talking about like, we can offset gains with losses and all of that. So the wash sale rule, for people that don't know, is basically this idea that I can sell Bitcoin when it's at a loss, buy back Bitcoin pretty much that same day or the day after at a similar price, and own the same amount, but I can use that loss that I just sold for to offset gains somewhere else, and then eventually up to $3,000 of ordinary income. The problem is most people don't even know this is a thing, because in stocks I can't buy Apple at 100, see it at 90, sell it at 90, and then buy it right back and have that loss. I actually have to wait 30 days after for it to be something that's allowed. In crypto, this could go away in the next year or so, but you do have the ability to sell at a loss, buy back instantly, and use those losses to offset taxes later on. And for people that are trading a lot, I mean, think about it, that can make such a massive difference on the amount of money that you have to pay in taxes if you do it the right way. But it does seem like this is something that is going to be going away, since they are traded like a security. It's super confusing because crypto is like traded like it's like a security, but it's also treated like a property. And so like nobody, we're all trying to do the best we can and interpret what we have from, the leaders, but it's going to be changing all the time, it seems like.
Yeah, and that's really where having a good tax planner is needed, right? Because the tax planner is keeping an eye on the pending legislation. So like if this new Build Better Back Act passes, well, what if they, impose wash sale rules retroactively to the start of 2022, right? Which is like what the Joe Schmo probably doesn't really think about or care about or, focus on, but an tax professional or investment planner is actively reading up on this and keeping an eye on it. So they may advise against, wash sales for 2022 because of what could be, Not to mention, a lot of folks don't. There's a rule called the economic substance doctrine. Got that right? And it pretty much states that, like, and it's kind of the backbone of the wash sale rule, which states you can't just like take a loss for the sake of like a tax impact. It has to kind of have some sort of like economic loss associated with that you can prove out. So if you sell crypto at a loss immediately and then rebuy it again, like, might be hard to kind of prove that there was a, any sort of other reason or rationale for you doing that other than the tax implications. But if you maybe waited a day or so, because crypto is so volatile, you can maybe make the claim that, like, I want to sell it now, and then maybe like check out what happened, right? Or if you just sold Ethereum at a loss and then rebought Bitcoin, because they're all kind of closely correlated, you can do that, and that's pretty fine there, because it's two complete different assets.
Let's talk about that. I think that one's interesting too, because that's what people say. If wash sale goes away, then you'll just basically do that. Like, I'll sell my Bitcoin at a loss, buy Ethereum because of the correlation.
Yeah.
And it is hard because, I mean, if you do the research and look, they are pretty correlated. So, and obviously not giving advice and telling people to do that, but it just seems like the next evolution will be, okay, well, we can't do that, but we're just going to find one that's very highly correlated and make that change, which is okay, because technically that's what people do in stocks. You sell one ETF and you basically go from Vanguard to the Fidelity one that is 99% the same. And that's how you do it.
Yeah, exactly. Or, I mean, I'm sure some people have, like, if MicroStrategy, that kind of like stock. I mean, it's pretty much like all Bitcoin. So it's like, essentially a stock holding it's a wrap ETF of Bitcoin that's levered like 3x or something. But you could theoretically just sell Bitcoin at a loss, rebuy that, and then literally just do the same process every 30 days, right? Whichever one's up or down. So
that's true too.
Again, these are the kind of tax, I won't say gimmicks, but like tax games you can play with a good tax planner, which you won't really get, legally on Discord or Reddit.
Yeah, I think so. Kind of recap some of the things. So you need to know for crypto, whether you sell within 12 months or after, because less than 12 months, your tax ordinary income rate, which is typically less favorable than long-term capital gains rate. So the taxable events, you don't have a taxable event when you buy, but when you sell, you do. Or if you go from Bitcoin to Ethereum, that is a taxable event because they view it as Bitcoin to fiat back to Ethereum. And so it seems like that's like the main points to know. NFTs are taxed very similarly, except for you might be able to get the long-term capital gains rate to 28%, depending on how you argue it. All of these things are definitely things that you need to be aware of. For you, like, what are, some of the best tax planning advice that you would give? Not like recommendations of things to do, but just like, for people hearing this conversation, leaving it, like, what are things that you want them to think about, or strategies that are important for them to think about?
And right off the bat, you should find some professional help is the first thing. And that's not a hard sell for you guys or for our software, but like, you conclude the very wealthy have a tax accountant, a planner, a lawyer, right, on a team to help them out. Whereas the regular individual has like neither. So there's clearly the strong correlation with wealth and professional help.
Okay.
Secondly, I'd say keep track of everything, either mentally, well, that's kind of hard to do, but keep track of it as best you can there, either on a spreadsheet or some software.
Even Coinbase now, they just had that partnership with like Coin Tracker or something else that'll help. Get a software that can connect to your wallet and keep track of your transactions. Because even on Coinbase before, if I'd go look, it would say I bought $1,000 of Bitcoin on October 22nd, but it wouldn't even tell me the purchase price there.
Yeah, it's really annoying. I'm with you. It's something, and that's where some of these softwares don't do the best job, especially if you're doing like DeFi stuff that's off chain. And if you have like, multiple wallets as well, it can get kind of tricky. So, I mean, the best advice is definitely keep track of it yourself. Not only will that help save you time down the road, but it'll also help the accountant or professional you work with, get a better chance of seeing all of your data as opposed to getting some gaps there. I mean, I think another thing is always like think about tax optimization. So like there's not just selling at a loss. I mean, you can donate to charity through like donor advised funds to offset some gains. there's things called like exchange funds. If you have enough gains, it's maybe worth looking into setting up some sort of trust for those gains, to kind of, without essentially do is kind of protect those gains in like a tax deferred vehicle.
Or use some
IRA.
tax deferred, use one of the places where you can invest in them inside of your Roth or
Yeah,
an IRA
right.
as well.
Right, exactly. Or yeah, right. Or do that. I mean, another one too, and this is me, I want to preface to not exactly financial advice here, but if you do have a good crypto gain, I mean, you can always take out like loans against your assets.
Same with stocks. Yep.
Right. So like, theoretically, if that's the case and you need some liquidity, like you're probably better off just taking a loan out against the big asset and somehow protecting it so it's not super volatile. And that way, like that loan isn't considered income. So you can get that kind of cash flow you need to support whatever lifestyle you got going on, but you don't have to incur a taxable transaction in order to. Right, which is huge, right?
It's the HELOC idea. Like, hey, I need to have a project on my house. Do I use a HELOC? Do I sell investments? It's, well, instead of selling investments, paying taxes and the time it would take to catch back up, maybe borrow at a lower interest rate, if that still exists. Obviously, with 4 hikes coming later this year, if all of a sudden you could borrow against your crypto from 2% and it goes up to 8%, that obviously might change the discussion.
Yeah, and I mean, I don't know too many providers that provide loans against crypto because it's so volatile. But if you could somehow figure that out, that's another good idea as well.
Yeah, I would add, like, on the part of like, do tax planning. I would say like do the tax planning, look at the tax impact, but don't necessarily make the decision only on the tax impact. Right. The other thing I will say is there's a lot of people who've made a lot of money in crypto. Understand that it's okay to take winnings off the table. Like, even if you are a Bitcoin maximalist, if your goal was like, hey, I need $5 million by retirement, I have $10 million today, well, maybe I could take out some of these gains, put it into very conservative portfolio, know that the rest of my life is cared for, and I can still leave my belief in Bitcoin with whatever percentage. But too many people stick with one idea, one company, one investment, and then all of a sudden you really never know. There's the Enron example. There's other companies that are great examples. Sometimes it is okay to take winnings off the table, diversify, have something a little bit safer, and pay the taxes. Like that can be okay too.
Yeah, absolutely. Considering that some other asset classes are taxed much more favorably, like real estate, listen, I think we're probably in the same boat here. I think the hard challenge is trying to convince some of these folks, because they're a bit newer and less educated on the tax space, why all this is important, which is kind of why I say the first rule should be work with a professional, because they can educate folks on the matter here, as opposed to like people just reading like I don't know, nerd wallet articles on taxes and thinking they're now a pro.
Yeah. No, I mean, that makes a lot of sense to me. I think this has been like super helpful and informative. I think this is like a good one for anybody new to crypto, to existing in crypto, since a lot of people aren't that educated on this side of it. Is there anything else that you want to add before we close out?
No, but I'm happy to kind of walk you guys through the platform down the road. We're aiming to have a beta out by like early March for you guys. I mean, Trayden, you've seen it already, and Thomas, I can kind of send you a video as well.
Awesome.
The key thing there, and one, I'm sure you guys have heard this before. Thomas, you kept alluding to this, but like, don't let the tax tail wag the dog. I think that's the phrase, which is pretty much like, don't just make a decision based on the tax impact, right? But something just to keep in mind. And I think that's a good piece of tax planning advice that most folks don't think about.
Yeah, and the reconcile platform's open to retail investors right now. Like, can people go on there and start using it this year?
Yeah, it's definitely open. I would say we're kind of moving it on to the other the accountant portal right now. So over the next few weeks, some things might break as we kind of move the architecture and everything. So wouldn't recommend advising other folks to try it out right now.
For sure.
Perfect. Well, we really appreciate you coming on and sharing your knowledge with all of us. I think this was a great episode. And we will be back next week. Thanks, everybody.
Yep. Thank you. See ya.